When you talk about your lenders, that your reoccurring lenders, so the debt side of the equation, are you doing institutional money? Is it private lending? Where are you guys at with that?
Yeah, so we've done a mix of agency debt with Freddie and Fannie, and we've also played with some debt funds, so bridge debt essentially. And so this was a bridge lender, like I said, we closed with 2 months ago. With that deal, we were under contract to close for 45 days. We ended up closing in 32 days, so we closed much earlier, and that's because again, systems and processes, and having a good team backing you, and we are able to do that. And we felt that that bridge lender, or that debt fund, so to speak, they had really good terms. They weren't too expensive, fixed rate on all of our deals, so we're very comfortable that we're not going to get that floater, or we have to pay a large cap on the rate lock, or excuse me, on the rate. And so repeat, we've been able to do that. So to answer your question, like I said, we've done some agency loans. We've also done some bridge debt loans as well, but very safe and under leveraged bridge loans. I should make that very clear.
So bridge loan debts typically are much shorter time frames. Are we talking 12 months, 24, 36? Or you get a full 60 on those? What are you looking at on those?
Yeah, so bridge is exactly what it sounds like. It's meant to bridge the gap from acquisition to stabilization. So all of our bridge debt we get is at least a 2 to 3 initial year term. So we have no prepayment penalty after 12 months though. So the reason why I like this and having a 2 year extension on all of our bridge debt is it gives us a multi-exit strategy. I think this is very important, especially in this climate. And it's fixed rate too. So we know exactly what the debt's going to be. So year one, obviously, we have the bridge debt in place because we're executing the business plan of stabilizing the asset. There's no plan to exit there. Year two, now the prepayment penalty is gone, so we have three options. We can sell the asset if we get a great offer. We can keep the bridge debt in place because it's fixed rate, it's not adjusting on us, nothing's changing, or we can refinance the debt because that prepayment penalty is gone. So we have three options year two. Year three, same exact thing. It's a 3 year term. We can keep the debt, we can refinance the debt, we can exit the deal. We've got multiple exit strategies. Year four, same exact thing. If I signed up for a 3 year term with 2 1 year extensions, sell, refinance, keep the debt. Year four, same exact thing. But year five, now at the end of year five, we're out of extensions, so we have to either sell or refinance. So it gives us those multiple exit strategies on the debt, and I think that's extremely important, especially in today's environment.
The bridge debt is so much about relationship. The underwriting is a little bit more laxed, obviously, than your agency institutional debt. So, what if you're willing to share? What are you guys seeing from the rate there on the bridge debt? Where are you kind of at? What's the fix?
Yeah, so it's going to depend not only it's going to depend on the price of the actual loan proceeds. So if you're 10 million and above, you're going to get a lower rate. You're going to get maybe a little bit better proceeds because there's not as much risk. It's a larger, more professional institutional asset. Once you get under 10 million, especially under 5 million, that bridge debt's going to get more expensive. The yield isn't as great. These bridge debts, they want to spend tens of millions of dollars. These debt funds, I should say. But if once you get under that 10 and 5 million, the amount of shops you can bring the debt to shrinks atrociously. So when you're under again 5 and 10% or 5 and 10 million, you're looking around right now anywhere from 6 to 7.5%. You might be able to get 5.5%, especially because the 10-year Treasury pulled back a little bit this week. So maybe you could find someone, but they might be a little more expensive on the fee side of things. So whenever I describe bridge debt and they say, "Oh, what's your rate? What's your rate?" Well, there's other things you have to look at because there's many triggers you can pull or many levers you can pull on the back end to get that pricing. What's your loan to value? What's your in and out is what we kind of call it. What's your entry fee? What's your exit fee with that lender? Is it 1% and 2% on the out, or is it 1.5% and zero on the out? So those are all things we're looking at. So to answer your question, we're typically locking in our deals at 5.9, 6.9% fixed rate, 1.5% in, 0% out, no prepayment after 12 months. And we got lots of room on the leverage. If we want to go 70% loan to cost, 75% loan to cost, we're good to go. And we typically won't go over 75% loan to cost as we feel even that is kind of over leveraging ourselves in a position.
Yeah, typically I'm comfortable around that 65%. 70 is doable depending on how the rest of the numbers shake out. It sounds like you go pretty conservative on your underwriting, which I appreciate in this type of market, especially. For again those that don't understand, you see a percentage of debt. Let's call it 70%. So that leaves 30% on the table that you raise in equity. Typically on your equity funds, what percentage are you guys doing? 90, 95%. Where are you guys at with that?
I'm sorry, repeat that question again.
For the equity portion of the equation. So we'll take 70% worth of debt. That leaves 30% of the table. Of that 30%, are you guys raising 90, 95% equity in that 30%? What's kind of your floating number you like there?
Yeah, you hit it right on the nail on the head. 90% roughly. So we're bringing in 10% of the equity in house, whether that's our personal capital or Victory Capital Group as a whole, the whole group, their personal capital. So always have skin in the game. And these are great projects. We want to get in on these opportunities as well with our own personal capital. I'm not putting money into the stock market, whether it's 2 years ago or 10 years ago or last month. Do I still have part of my portfolio in there? Most definitely. But I choose real estate all day. And so we're taking up a percentage of that equity piece, at least 10% of the equity piece that's going from us.
So you've got 70, let's call it 70% debt, then you're raising 20% of the remaining 30 and you're putting in 10. So for the LP, the limited partner in this equation, I'm assuming you're doing a 506C, a Reg D 506C type raise. Of that 20%, are you doing 7% preferred with a 70-30 waterfall after, or how are you guys doing that typically? Or does it depend on the deal, I guess?
Yeah, so it's definitely deal dependent, but typically we're doing 7%, 75, 25, 222 for the fees, or 2222. So that just means 7% pref, 75% LP, 25% GP, and then when I'm saying two down the board, that's 2% acquisition, asset management, disposition, refinance. So again, it's going to depend on the deal. Some deals we have a 1% fees across the board, or 2% with 1% asset management, or we did a super small deal and we needed the higher percentage. We did 3% on the acquisition because it was just such a small dollar amount and we kind of had to cover our costs essentially. So it's just going to be very deal specific, but typically that 7% and 75-25 is very typical for our model.